a conversation forward and let's understand from him where he feels there is value in the market, where markets are headed. Mahesh, good morning. Thank you for joining us. It's been a nothing sort of a stellar run for equity markets in general. For a market where 3 months ago all of us thought that things would go down, valuations were expensive, the comeback by the bulls is strong and unreal. Do you think bulls were back? Are they here to stay? Do you think these gains will sustain? Can markets build on these gains?
Yeah, good morning, Nikhil. So yeah, it's been a kind of markets climbing the wall of worry, right? This year we've seen all the negatives and the markets continue to move, especially our markets. So the key question, as you rightly asked, is whether we would see further upside. So clearly, I think on the global front, I think we've seen again some kind of rally. Again, the concerns about U.S. Increasing interest rate to what extent, right? Where the terminal rate will be. I think that is clearly now kind of anchored in around. The only question remains is how long the interest rate remain and to what extent it will have the impact on the economy. So I think that is something which we'll only know in the next calendar year. And to that extent, I think the real picture in terms of slow down the earnings impact, you will see the next calendar year. So I think that will drive the global markets, and to some extent, it will weigh down on our markets. But I would say that clearly, I think looking at the earnings which have come through in this quarter, there have been some kind of mixed earnings results, but on an overall basis, I think the growth outlook still remains fairly intact. We have seen probably a couple of percentage points downgrade to earnings growth, but it's still higher in the high teens. So given that, I think, and the fact that as we move forward into next year, we still expect the earnings growth to be into double-digit growth. So if that is the scenario, then I would say the markets will continue to move higher. I think there will be periods of volatility. You will see some correction, especially I think in the next year. I think as you step into that, I think in the initial period there would be some amount of correction. But as the picture gets clearer, I think the markets clearly looks to scale higher going forward.
I'd like to draw your attention to financials. Every fund is overweight financials, and that has done very well for investors and for fund managers. At the current juncture, after the recent bout of outperformance, do you think financials now could underperform or could just remain sideways?
So the financials, that's been one of the reasons why the markets have done so well, again, being a large part. And if you look at in the last 3 months, that has led the rally in the market. And rightly so, I would say, because we've seen good, very strong numbers from the banks. And it's been across, right? Not only the retail banks, but the private banks, but also the PSU banks. So I think that still looks to be, at least for the next couple of quarters, we're seeing good growth because the margin expansion, what we've seen on the back of higher interest rates, I think that will still kind of benefit for the next 1 or 2 quarters. Obviously, the challenge is that the deposit growth is lagging behind the overall asset growth. And that could probably start to differentiate between the banks which are having a good liability franchise. I think they would probably do well in a rising interest rates environment in terms of protecting their margins. So I think looking at the fact that the credit growth is still fairly strong in the mid-teens, and the fact that margins are fairly trajectory is still upwards, and overall credit costs remain low, at least in the foreseeable future, I don't see any reason why the banks should not do well. Valuations also there are kind of near the long-term average. It is not expensive, and that's unlike what we see in some of the sectors. So I would say that the banks all as a basket. NBFCs could see some pressure because we've seen the rising interest rate environment. There has been margin pressure, but as the assets, some of the assets are fixed loan assets, they will start to reprice in the next 2 quarters, so that should take care of it. So I think remain positive on the whole banking and financials. I think it's one of our thematic calls. Okay, if somebody wants to really take a next 2-3 year view, it's a good thematic call to invest into. Okay, through some of these bank and BFSI sector funds.
Right. Mahesh, just wondering, outside the list of financials, given the kind of rotation that is taking place in every sector, given that newer themes, especially CapEx, seems to be the go-to with the market right now, starting off with banks to construction companies to cap goods, defense, and now railways as well. Any of these pockets where you have a conviction buy?
So on the capital good, I think it has been a kind of a, hope kind of a thing that capex will come back. It's been for many years we think about, but finally I think it is coming into place. We are now seeing actually companies getting the order books improving in the last 2 quarters. Again, within that space, it is some of these small engineering companies, okay, which are doing much better. The very large ticket capex is still kind of some time away. I think it will take time in the current context where there is some concerns about growth. I think that could get deferred a bit. But small size engineering companies, I think they are doing fairly well. Sectors like defense, for example, where the government is really focused in terms of trying to improve the local sourcing, is seeing a good traction. We've seen orders being given to some of the domestic companies, and I think there the outlook remains fairly strong over there. We've seen a few of the companies in the capital goods sector getting some orders from the European region because the disruption which some of these companies are seeing in the Europe, they are looking at outsourcing from other markets, and a lot of these MNCs which are there in India, European MNCs, they have a presence over here and they are looking to source from India. In fact, considering the fact that the cost in some of the European region is now going up significantly, even a few companies are looking to relocate some of their manufacturing into India. So I think given that scenario, while the overall capex recovery is still going to be slow and muted, I think the outlook uh, broadly on the sector, and especially somewhere something related to defense, and even to some extent on the railways also, we've seen the in specific areas, the ordering is starting to improve. So by and large, I think this sector outlook looks good. The only key concern at all about a reservation would be the valuation because the stocks have run ahead of expectations. And to that extent, I think one needs to be slightly guarded in terms of where the visibility of growth is slightly longer term.
Okay, that's the view coming in on the entire capital goods space as well as defense and railways, which you believe are improving in terms of their overall order booking. But outside of that, are there any other sectors, Mahesh, that you believe merit a look at? Say some of the specialty chemical spaces, anything within media that you like, or even within the cement space?
So, some of the sectors, okay, there could be short-term challenges because of the current global environment. I think we have to look beyond that and take a longer-term view because, so in that context, I would say the specialty chemical sector, while near-term we have seen some margin pressure because of the supply side disruptions, commodities, some of the prices which have gone up, and to some extent some slowdown in the European side. But I think we firmly believe that the sector.
Oops, we seem to have snapped that line. Mahesh was talking about the entire specialty chemical sector, how there have been some challenges, but in the long term, Mahesh, continue specialty chemicals.
Yeah, so I think in the longer term, we've seen that a lot of companies are looking at, especially from European region, they are seeing their costs go up significantly, and longer term, they are looking to outsource a large part of their manufacturing outside of their region, and Indian companies are likely to benefit big time in the coming years. As you know, India is still a small percentage, 4% of the global chemical exports trade, and that percentage can go on. So I think that sector looks good. Cement is also after the recent last quarter where we saw margin pressures. I think the cost and inflation is starting to ease off now, and demand recovery has been fairly steady. So again, that sector looks good to us from a medium term perspective. And apart from that, I think the whole recovery play which we've seen play out in the airline sector or in the hotel sector, I think that demand is still fairly strong, and I think that will continue getting into the next few quarters. So that, I mean, the whole kind of discretionary spend more towards travel and in terms of the hotel sector, I think that should do well.
Good morning. I was going through the recent changes that have also been made at the AMC, and what I did notice was that the recent sell-offs include Pfizer as well as Dr. Reddy's Laboratories. The question I want to ask you is, especially after this earnings season, where it's actually Sun Pharma that has really stood out, are you not as bullish on the pharma pack anymore?
The pharma sector has been, I think, more stock specific for us. There have been some headwinds in the pharma sector on the US generic side. Again, we are seeing pricing pressure, which were kind of eased off a year back. And so I think the pharma sector, domestic pharma companies still look fairly good. We like domestic pharma space more. Amongst the export-oriented companies, the companies which are now moving up the value chain into specialty pharma, I think they will be able to hold on to the pricing environment much better and hold on to the margin much better. So while there's no big tailwind to the sector, okay, coming in from the US on the export side, but it will still remain a stock-specific story for us. And there is always this risk of US FDA issues, okay, plants, okay, getting inspection where there are warning letters. So that this still remains. But I think domestic pharma is where I think the higher allocation is there for us. And on the export side, it is going to be more stock specific.
Okay, thanks so much, Mahesh Patil, for being live with us today on the show to talk to us about the markets at large and the new pockets of growth that you have identified.